Thank you very much, Craig.
Morning, James. My pleasure. Thanks. I was listening to that with great interest. Thank you very much.
Cool.
Always good.
Good. You should be able to move the slides now, if I've done this right. There you go.
Yes, there you go. Perfect.
Very good.
Thank you.
All right, so I'll let you introduce the fund. Please tell us a bit about it, and then we'll get to some questions.
Great. Well, thank you, James. I'm chairman of Dynam Capital, and we're the investment manager for the London-listed Vietnam holding. And we've been winning some awards and for doing simple things well, which we want to continue to do. We're a shade under £100 million, listed on the main board of the London Stock Exchange, part of the FTSE All-Share. James was making some interesting points around some of the other trusts that he was talking about this morning, around the need for good governance and for listening to your investors, to your shareholders. And I think we're very proud that we do that. We have an independent board. The trust has a regular share buyback mandate. We were one of the first trusts to have an annual redemption facility. So each year, effectively, we put ourselves up for vote. Shareholders have the chance to tender their shares once a year. And the aim of that, of course, is discount management and showing that we're in it for the interests of the shareholders in the fund. For us, Dynam, we're a partner-owned team, focus 100% on what we're doing in Vietnam and trying to create value for our shareholders with a strong locally based team. We're 19, the fund's 19, and then 19. Next year will be 20. And over the past 5 years, we've delivered about a 20% compound annual growth rate in NAV. That's in US dollars, that's after fees, that's after FX effects. And that's against, if you want to look at it against the index, we're not an index tracker, but against the index we've generated about 500 basis points per year of alpha by doing simple things well. We're long only, we've got a portfolio of companies, Vietnamese companies, all listed, about 25 to 27 at any moment in time. Largest holdings about 10% of the fund. We don't use any gearing, we're not using any complicated instruments, we're stock pickers, we're managing a portfolio, we're very nimble. And that's necessary because, as you'll see, Vietnam's a superbly interesting market, very dynamic market, so you have to be very nimble in what you're doing. We're very proud that we've been a long-term responsible investor. We've knocked it out of the park in terms of our scores that we get from the United Nations PRI. It's under the Principles of Responsible Investing. We're one of the top scoring responsible investors. Again, we want to do more, measure more, and report more on how we manage our portfolio along strong responsible investing lines. And we track our carbon footprint, and we're encouraging our portfolio companies to be very aware of their impact on their business and in their country. As you'll see, there are a few simple themes that emerge out of Vietnam about its industrialization opportunity, the growth in the domestic consumer, and the urbanization as the country modernizes. And there's a long way to go and very exciting opportunities ahead. We're an active manager, and we're not constrained by size. We're able to invest in small, medium companies. And many of our companies are now what we class as large cap because they've been growing at such a great rate over the last 5 to 10 years. So Vietnam, at a glance, for those not familiar, it's got great geography, and a lot of people say geography creates a country. It's got also great people. It's got 100 million people, high level of literacy, very digitally savvy, cheap, fast internet. Everyone's got mobile phones, everyone's got fast internet connection. And the country as a whole is urbanizing. It's still at a relatively low rate, 39 or 40%. Think of China perhaps 25 years ago, and China kind of massively increased its urbanization rate. So lots of opportunities for growth in the cities. And just very interestingly, about 6 weeks ago, the country reduced the number of districts, the number of provinces, from 63 down to 34, meaning that Ho Chi Minh City, which is the city in the south, Hanoi is the capital in the north. Ho Chi Minh City now is an expanded mega city, and that's creating great opportunities for modern trade and other opportunities. Vietnam's been growing rapidly, around about 6.5% for the last 30 years. Government isn't sitting on its laurels. It's saying we want to be 8% to 10%. wants to avoid the middle income trap that some countries perhaps are going to fall into over the next 10, 20 years. Strong growth in GDP, moderate inflation, record levels of foreign direct investment, and a big trading nation. As Donald Trump said on the 2nd of April, a great nation, great people, they like me, I like them, but we've got to talk about trade. And we'll talk about trade in a little bit there. But a reminder to the key investment themes for the fund, which fall out of the natural opportunities in Vietnam around industrialization, that's the modernization of the economy, the domestic consumption story, urbanization, and increasingly digitalization. Vietnamese are very quick to adopt digital technologies. It's also adopting AI, it's adopting cryptocurrency. About 1 in 5 investors, domestic investors in Vietnam, claim to hold cryptocurrencies in their portfolio. So keen to try new things and to grow. 20 years almost the fund's been going, and we've seen tremendous growth and change in the opportunity set in Vietnam, but there are many catalysts for further accelerated change. As I mentioned, the government's adjusted the provincial boundaries in Vietnam. There's a reform of the domestic economy underway. We're hopeful that soon the country is going to be upgraded in terms of its stock market from frontier to emerging market, and that's going to be very positive. The country's debt is 1 notch below investment grade. Once they get to investment grade, that's also going to see flow of international finance that will be really important and accelerate the infrastructure development. For those that know Vietnam, have been there, it's notionally a communist country, although Ho Chi Minh, perhaps the nation's founder, was more of a nationalist before he was ever a communist. But notwithstanding that, the Politburo, the political decision-making arm of the government, says the private sector is important. That's what's going to drive the economy, and that's what we're going to support. And indeed, there's a number of plans being put into place to create a new international financial centre in one in Ho Chi Minh City and one in Da Nang, which is halfway up the country. So a real push to using the tools of capitalism and the market economy to further grow the wealth of its people and modernise the economy. So as I mentioned earlier, decades of 6 to 7% GDP growth. Wouldn't you love to have that? I think the UK's lower single digit when it announces its numbers. And for the first half this year, record levels of GDP growth. We'll talk about tariffs briefly. Everyone's getting bored about tariffs, I'm sure. Eventually, April 2nd, there was a high level announced of 46% on Vietnam, but now closer to a 20% reciprocal rate, with a 40% rate for tranship goods, which the details remain unclear. But that said, the rates are broadly in line with market expectation. Significant public infrastructure investment is going to drive GDP growth further. You've got an accommodative interest rate environment and stronger demand for credit, which means the banks are in a very interesting space and they're a key part of our portfolio. And as I mentioned, the government and the Politburo want to prioritize the private sector. Record number of new enterprises, and Vietnam's got heaps of entrepreneurs that want to do really well. So we're looking to back some of those in the future. So the government's targeting 8% GDP growth for this year, and it has ambitions for even higher levels of growth going forward. So almost the last word on the tariffs. Sharp reduction from what was known as Liberation Day. Interestingly, perhaps, some of the countries close to Vietnam are at 19%. That number keeps popping up, doesn't it? Vietnam's at 20%. That's probably a little bit of a signal, which is, we know you're exporting a lot of stuff to us, and we're worried that that's contributing to our deficit from the US perspective, and we're keeping a close eye on the transshipment of goods through places such as China. That said, it's a reasonably manageable level of tariff. Tariffs are not good in our opinion, but it is what it is in the world that we're living in. And there were already some tariffs in place, so it's not a complete hangover. Many of Vietnam's exports to the US are not actually the target of transshipment or for what the US looks at as in terms of reshoring, and many sectors do not face tariffs. And so the key competitive position that Vietnam's positioned itself in over the last 30 years as a manufacturing superpower, a manufacturing center, a China plus one option for manufacturers is still intact. And we see that in the foreign direct investment levels. So Vietnam is both an exporter of many different categories of goods. It's not a one-trick pony. It's a big exporter of electronics, as well as textiles, footwear, and agricultural goods, coffees, and fish products and aquaculture products. It's also a broadly based mix of trading partners. Interestingly, also, it's starting to import more from the US to kind of balance the book, so to speak. And that's in terms of agricultural opportunities, agricultural foods, and then in the future, more energy perhaps from the US. So Made in Vietnam continues. Foreign direct investment is at record levels, both in terms of the registered amount as well as the actual dispersed amount for the first 7 months of this year. And as a manufacturing center, the manufacturing index is back into expansionary mode. It was hit in April when there's a lot of nervousness, but back to expansion. A lot's been happening on the domestic side, which perhaps hasn't been reported as widely as the tariff story, which is a global concern for people. Domestically, Vietnam has been ramping up its public investment in infrastructure. And this will help leverage the economic growth. So this will help the government try and achieve more than 8% in terms of GDP growth. And so the Prime Minister is really pushing hard to have a record level of domestic investment. And some of these are going to be for multi-year upgrades to the country's infrastructure. I love trains, and I was recently on the trains in the north of Vietnam. They're not high speed yet. And there are a lot of plans to develop a high-speed rail network from the north to the south of the country, which is a very long journey. I encourage you to watch Michael Portillo's Great Asian Railways to get a sense for what that journey is. It's a wonderful journey, but it's a bit slow. It takes about 37 hours. So that's going to be developed over many years, but also the rail network in the north that connects to China is going to be developed, as are other parts of the country. So economic growth will be accelerated through that multiplier effect of infrastructure development. So the Vietnam equity market is only 25 years old, and yet it's driven to tremendous heights. And in recent times, it's actually hit record index highs. So it's recovered from the fear factor in April. And liquidity in the market has peaked close to $2 billion a day. That's the highest in Southeast Asia. So many people are surprised by that. And it's in part because you've got 10 million domestic stock investors in the country. So that's 10% of the population. That's way ahead of the UK, way ahead of Europe in terms of the domestic people investing in their stock market. And so it's a very vibrant market, at times volatile because of that domestic activity. But we're seeing strong levels of liquidity, strong gains for the domestic investors. And that's encouraging people, again, to look at perhaps some IPOs. And we might see some IPOs later this year and some into next year. And that will broaden the market as well. And that's an attractive opportunity also for more foreign capital to come into the market. So although the market's re-rated in recent weeks and months, it's still attractive. And if you look at Vietnam on a regional basis, it's also compelling on its growth and its earnings. And for us, we're looking for good growth in companies. We're looking for businesses that can generate 20% earnings plus per annum at reasonable levels of valuation. So for us, we're not doing anything clever. As I mentioned at the introduction, we're a stock picker. So we're looking for good businesses that fit within the attractive kind of themes that we see in the country. The domestic consumer, the industrialization, the modernization of the country, and the urbanization. We're very patient. We track companies for multiple quarters, many years in some instances, before they come into the portfolio. We've probably got a smart universe that we look at of maybe 60 to 80 companies. There's 25 to 27 in the portfolio at any time. And then there's some waiting in the wings. These are either businesses we've taken profit on or companies we've been tracking for time. And when it's right, we'll add those into the portfolio. Part of what we're doing as we're waiting over that period of time is seeing how the governance is improving in these businesses. So we have a strong focus on environmental social governance, and that translates into responsible investing, which translates into having conversations with companies from everything from how they organize their boards and their decision making and how they deal with conflicts of interest, through to how they're adapting to climate risk and climate change in the country as well. And we've found that that closer engagement we have with those portfolio companies means that we can panic early when we need to, or we can see how our conviction is playing out. So we'll start maybe with a company in our portfolio at a 2% conviction level, and we'll increase our conviction as we see that the management team does what it says it's going to do. So this was as of June. We've got a mixed selection of companies and sectors. So we're conviction driven, so more than 2/3 of the portfolio is in the top 10. We've got a number of banks in our portfolio because banks are a great leveraged play on economic growth in an emerging economy. And the banks are relatively cheap, yet they've got good growth in their earnings per share. They've got maintaining their net interest margins, and their non-performing loans are under control. We've also got a couple of strong retail opportunities. So the rise of that domestic consumer in Vietnam. And we've got some companies such as Mobile World in our portfolio, which are omni-channel champions. They've got bricks and mortar and they've got clicks through their online offerings. And some of these have been opening stores regularly, and they've got a very fine model for adapting their products to the growing modern economy. So that's the portfolio in a nutshell. Simple things executed well. We're fortunate to be in such a dynamic market such as Vietnam. It's got many years ahead of its growth, and it pays to be nimble such you can continue to deliver outperformance in this market. And for the fund, we're pleased we've got a very narrow discount to NAV, regular buybacks through the board, and as I mentioned, an annual redemption opportunity. So we listen to shareholders, high levels of governance, and want to do simple things well on behalf of our investors. So I encourage people to have a look at Vietnam and to have a look at Vietnam Holding to get a little bit of diversification to their portfolios and a bit of the exciting growth story of Vietnam.
Brilliant. Thank you very much, Craig. We've got some questions, but please do put some more into the chat box as we go. Actually, let's go back a bit so we can see there's the portfolio there. There's a question here about semiconductors. Is that something that Vietnam has got much exposure to?
Only on the periphery, James. So for many years, there's been a lot of investment into the assembly and test. So Intel from the US, obviously having its own issues recently, a couple of $1 billion in packaging, assembly and test of semiconductors. You have Samsung from South Korea, massive investor in Vietnam. Again, some R&D, some packaging, assembly and test, some software development for semiconductors, but we don't have any fabrication plants. That's a massive capex, and it doesn't really play to Vietnam's current position. So it's part of the semiconductor chain, but it doesn't have any primary fabrication plants. For those, you'd go to Malaysia, Singapore, or South Korea.
Yeah. Okay. Great. Thank you. And then, just looking at your bank exposure. So the question here is around state-owned banks, and it mentions Vietcombank, which I think is quite a big stock within the index. Is that true? What's your attitude towards state-owned enterprises?
Well, over the years, and the stock market's been going more than 20 years now, you're seeing improvements in governance, you're seeing improvements in the growth of these businesses, but fundamentally you're seeing the banking sector develop. You're seeing what was an underbanked population now get more access to financial products and services. So that's why generally we have a number of banks in our portfolio. But for Vietcombank, that's also the kind of financial glue to the broader story of infrastructure growth and development, financing the export story of Vietnam as well. So Vietcombank's a very good kind of proxy on the story within Vietnam, and yet at relatively attractive levels of valuation, and it's actually a reasonably well managed bank. So a number of our banks have still got kind of state involvement or some state ownership, including military bank, which has a scary sounding name, but is actually a very modern, dynamic digital transformation bank. So we're actually underweight the banks, believe it or not. The index is about 40% in banks, and we're about 35%. And then we've got only a few of the banks in our portfolio. So we're looking for kind of good category champion leaders in their kind of subsectors. And there's a big push onto digital transformation in banking as well. And that's what's pushed the rise in the kind of bank penetration in Vietnam.
Yeah, that's sort of mobile banking, I suppose.
Yes, mobile banking, so apps on phones for banking, and then they can cross-sell with products as well, be that insurance products, or some of them have affiliate stockbroking companies, so for stock companies. And using digital technology to kind of leverage that is not a checkbook system in Vietnam, credit card and mobile payments, and the growth of kind of digital native offerings as well from some of these banks. And look, there's a tremendous amount of wealth in Vietnam. Vietnamese people can't invest outside of Vietnam. So unlike you in the UK, James, you can say, I like Vietnam, but I also like South America. I want to be in bonds, I want to be in equities, I want to be in US equities as well. In Vietnam, people have got, they can invest in cash, bank deposits, buy fixed income, they could buy real estate, they could buy gold, they could buy some crypto as well, which they do, or buy into the stock market. And so there's a lot of wealth that's kind of, some of these banks are trying to unpick that. So by creating more domestic financial products and services to kind of get the money from underneath the beds, so to speak, and into productive use. So there's still a long way to go.
I'm going to chuck in one question of mine, actually. Is there like a pension system?
Slowly and growing. So there's a social security system, and companies kind of contribute to that. And so it's starting to develop, and private pension plans are very nascent. But that, we're expecting to see tremendous growth in the capital markets broadly defined. At the moment, it's domestic retail investors are 90% of the float. Foreigners are less active on the daily basis, although they own about 10-15% of the stock market. Then we expect to see the growth in the domestic financial players. We've already had life insurance players very active in the market for 20 odd years, and then domestic pension funds will start to grow. And as Vietnam, we hope, moves to an emerging market status, we'll see perhaps some re-rating and then a greater flow in from some foreign capital as well. So it's at a superbly interesting time. The emerging market move, we don't know when, but it could be as early as end of September.
Oh, wow.
By FTSE Russell. So that would be interesting. But nonetheless, earlier this year, there's a new stock exchange system, and that's handled more modern delivery of services to stock market investors. So broadly, all good news around kind of institutional quality of the system going forward.
So we did have a bit of a sort of real estate bubble a while ago, and that's rectified itself. What sort of real estate exposure have you got now?
Well, you make your luck, don't you? So for 3 years or so, we were very underweight residential real estate, and that's because it was a tough time. A couple of big developers, unlisted, had been thrown in jail for abusing the bond market and for other nefarious activities. And it was a big stick taken to that, and it kind of froze the bond market for these property developers. So there's fundamentally strong demand for property, but the property developers were hamstrung. So I think we're seeing that come to the end of that cycle, and you'll see in our portfolio that we've started to reallocate to some of the real estate names that we've known for many, many years. And they're seeing more sales of their product because fundamentally the demand is there, and there'll be greater demand as the country continues to urbanize. There need to be millions of houses built in the key cities. So some of those kind of well-established real estate names will come back in. So we're now back up to about a 10 to 15% allocation to real estate. Some of that is residential, and then some of that is industrial. So the industrial parks and the services for the manufacturers as well. So residential was out of favor for the last 3 years, but starting to come back, and we're becoming a little bit more convicted by some of our names in that space, supported by fundamental demand from people wanting to buy houses to live in.
One of your sort of competing peers has exposure to unquoted. Is that something that you do at all?
But we have the facility, but we're finding better risk reward in the public market. So in theory, we could be 20% unquoted, but we're getting, we're delivering 20% compound annual growth over the past 5 years through the public markets, where if we've made a mistake, we can get out. And we're humble to admit that, occasionally you make it wrong, you make a wrong call, you have a conviction and they don't deliver, so you exit. Whereas if you're in a private company, you're stuck. I think you mentioned from one of the other managers, you've got to manage those out sometimes. So we have the skill set to manage private. It's not that we don't have that capability, but for risk reward, and we're seeing good liquidity. Our portfolio is actually very liquid, and that's maybe partly why we can support an annual redemption, and partly why our discount is very narrow. Earlier this year, actually, we were at a premium to NAV. We got very excited, and we even started issuing shares again for the first time in 15 years. So we hope those days come back as well soon as well.
Yeah, I'd like you to be bigger. I think that would be a very good move.
Yeah, we've got plenty of strategy capacity, and still allows us to be nimble around our stock selection and our portfolio construction.
Obviously, though, I mean, if you do get tons of market stress, is there ever a sort of time when it sort of locks up, or is that something because of the way you're managing the portfolio, you don't have that issue?
Look, 5-6 years ago, yes, because the market liquidity was lower. It's close to 2 billion at times, so it's 5 or 6 times where it was 5 years ago. What you tend to see is a falling knife. But you have a lot of domestic investors, and the market's down 7% a day. And we saw that in April, right? 2-3 days of down 7%, which is the limit per day. And then you're down 20% and everyone's glum. But there's still liquidity. So we saw liquidity, draw in a little bit, maybe $500, $600, $700 million a day. But in our portfolio, many of the companies are now much bigger than they were when we first invested. Some of them are, 5 times the size or 10 times the size. So they happen to now be larger cap, and there is more liquidity there. So it hasn't been a problem for us, and not that we would, but we could liquidate the portfolio, in 30 days or even less, actually.
And obviously that set off that we can see there a bit. That was a fantastic buying opportunity. Do you actually sort of buy some stuff at the bottom?
Well, we did. We don't try and time markets. We're all in the business of looking for quality names, and but we use the opportunity sometimes to kind of reposition. And I should say that with what's happening at the macro level, the country is really pushing hard on some new areas in the domestic economy, and so that's giving a real boom to perhaps the construction material sector. So we're cognizant to that. So we've been building up a little bit more of a position in a leading manufacturer in steel. That's going to go into the rails for the high-speed railway, but is going into the rebar for the real estate projects as well. So you've got to be nimble. You've got to don't just sit on your hands around that. So we did add to a few positions that we wanted to around that. And actually the portfolio is quite different now from perhaps where it was a year ago. Some of our names have increased, and we've taken some profit in some of our other category champions. And we recognise that back in April there was a lot of uncertainty. So coming to that tariff position, actually we built up our cash a little bit. Normally we're maybe 2-3%. In that period we went a little bit higher, 5-6-7%, just gives a little bit more flexibility in what was an unfolding story.
Can you use gearing if you want to?
In theory we could. We don't have a facility in place though. We don't find that we need to.
There's enough excitement already.
There's enough excitement, there's enough growth. We've got businesses that are growing at 20-30% earnings per share growth a year at relatively attractive levels of valuation. So we don't need to squeeze it even further through leverage. But if we wanted to, we have the ability to put a facility in place.
Do these companies pay dividends?
Yes, they do. On average, maybe the dividend yield across the portfolio is maybe 2-3%. Some is much higher, 6-7%. We as a trust don't pay a dividend, however, so we reinvest that. We also do use some of the cash for share buybacks on a regular basis. Although I must say, since putting in place the annual redemption facility, the share buybacks have been relatively modest. They do happen, and the board manages that, not as the manager, but less than in terms of volume than perhaps before we put in the annual redemption feature. So there is a dividend. The companies do grow their dividend as well, but we don't distribute the dividend. We reinvest that into the portfolio.
We can't ignore it, but the tariff thing. Were there any specific companies that were affected that can't really struggle with are going to struggle with a 20% tariff, or?
Not really in a fundamental perspective, but fundamentals are more the purview of us and foreign investors. The domestic investors react differently. So during the April-May kind of uncertainties, those companies that were more exposed directly to export, some of the industrial park developers got a little bit sold off, and some of the logistic companies got a little bit sold off. But domestic logistics, domestic air transportation is growing and rebounding rapidly. I should say, in all transparency, so 5 years strong alpha against the index, even though we're not index track. This year, currently we're below the index, and that's because the domestic market reacts very quickly on different themes, not perhaps looking at the fundamental aspects of the story. So we're catching up this year, but I say our long-term track record is very evident, which is that of outperformance and generating alpha. But this year, the domestic retail investors are ahead of the game, and they've been pumping the market pretty aggressively as they've got rebounds in enthusiasm, and they see some of the ambition of the government and what that means in terms of infrastructure and new railways and new projects and opening up of new opportunities. So they get pretty excited, and that's an active part of the stock market. So some of our quality blue chips perhaps were oversold, partly by the domestic investors, but also foreign investors have not been flooding into Vietnam. It's been quite the opposite for the last 2 years.
Yeah.
And I think that's the same across many emerging markets. People have been saying, I can make all my return in the US in 7 stocks. Why do I need to do research on emerging markets? We think that will change. We hope that will change. And then if we'll have a perfect storm. We'll have the foreign investors coming back in. We've got a strong, buoyant domestic investor base, and maybe an emerging markets upgrade. So it's going to be a very interesting 6 to 9 months, I reckon.
And I know you've said that it's important to focus on the corporate governance. Can you just explain a bit? So is it really easy to talk to the managers of these businesses? Do they listen to you? And obviously you have votes on things. Are there sort of floating blocks that mean that they get their way in? I mean, I wouldn't have been thinking about third point, but yeah, we don't have anything like that.
Yeah, well, very interesting. You're right. Well, look, for us, it's a key thing. So we've got a framework of about 80 questions in our questionnaire that we run each of our portfolio companies through. We don't expect them to score 100% on that. We want them to, get a C or a B, and then push them up to an A star in a few years' time, if in an A-level perspective. But we do expect them to engage with us. And one of our kind of litmus tests is if companies stop talking to us and answering our calls and our queries, we red flag them, and if they do not provide a good reason for that, then we exit them. So having access to the management, having them know the importance of investor relations. Now, we're happy to help. We advocate, these businesses can have better IR teams. So many instances, we've actually helped these companies put in place an investor relations plan and a team. For many of these companies, we've helped them put in place an ESG officer and to look at their responsible frameworks for themselves, because this is critically important going forward. So we're active on that, and it's a kind of self-fulfilling prophecy. If they don't take our calls, they're either not going to be in our portfolio or they're not going to be in the portfolio for very long.
Yeah, fair enough. That makes sense. Another thing that we have to think about, I suppose, is the currency. Obviously, the dollar's been getting weaker. Is that actually good news for Vietnam, or could it be a worry at some point?
Well, I think if you look back, step back a lens, and look through a longer lens rather, in the last 30 years, the currency has been devaluing against the US dollar 2 to 3% per annum, and that's kind of the trend we're on at the moment. So this year maybe 3 and a little bit more percent. A strong dollar isn't great for emerging markets, I guess. So if the US does weaken a little bit we do anticipate that being a benefit. But Vietnam is also a big exporter, not just to the US, globally. That also is a common occurrence for an exporting emerging market. So it's not an issue that perhaps it was 10, 15 years ago when FX was a big concern in Vietnam. Now, because of foreign direct investment, because of the inward remittances of overseas Vietnam, because of the trade surpluses, that's given it a bit of a cushion over the last few years against the foreign exchange risk. And so they've got a little bit more flexibility. And also they're managing a little bit better. And they track the Vietnamese currency, the Vietnam dong, against a basket of currencies. Includes the US dollar, but it also includes the renminbi, includes the yen, and other currencies. So it's better managed, and it's not really a particular issue. But I say our returns, that 20% per annum over 5 years, is after the impact of a 3% annual depreciation of the currency, and after our fees. So actually, we've got a good buffer in terms of our performance now.
Yeah, and actually, could you hedge it if you wanted to? Is that a practical thing to do?
It's not practical. In theory, you can, but it's very expensive. The Vietnamese dong isn't internationally traded, so you can enter into non-deliverable forwards and all that kind of fancy stuff, but that's expensive, so we don't. There's some natural hedges in the portfolio, those companies that export versus domestic stories, but we don't hedge. We'd probably get it wrong, and it's probably too expensive, so we don't. We just factor that into our models and our kind of underwriting for businesses. Have they got 20% earnings per share growth plus in them, and how exposed are they to FX? And in the broad play of things, it's not a major issue for us.
Yeah, fair enough. Good. All right. I suppose I don't want to sort of major on it because for ages and ages, the whole story was at some point you're going to get upgraded to an emerging market, and then everybody's going to come flood in, and the market's going to soar. And it hasn't happened, and it hasn't mattered that it hasn't happened because the market's kind of gone up anyway. But what do you think might happen if we get into the MSCI emerging market, which is more tracked than the FTSE Russell one? And when might that happen? What's stopping it from happening?
I think that's a long way away. I think FTSE Russell's more near, and I think Vietnam's done everything it needs to do for FTSE Russell. But they go to their constituents who say, yes, there's a level playing field for foreign investors, and that gives them the ability to upgrade it. I think several sovereign wealth funds do look at FTSE Russell. So that's an important flow. So it's an important flow point. You'll see a few extra $1 billion coming in, but I think it's a stronger signal that Vietnam's doing everything it can to deliver deeper, more competent capital markets. And there are big investors sitting on the wings waiting for this to happen as a signal, rather than, okay, now I can allocate more because you're in. It's just that you're doing the right thing, you're on the right trajectory. So to answer your question, for MSCI, the markets need to get bigger, or the restrictions on foreign ownership on some sectors need to get reduced. Because at the moment, I think there's more than 10% of the index which is uninvestable for foreign investors because it's at that limit. It's not uninvestable, but it's a deterrent for the kind of passive tracker funds. And they're the constituents of MSCI. So the markets either need to get bigger, you need more IPOs. We may have some starting again after a long period of time where there's been no substantial IPO in the market, and issuing more stock and perhaps some adjustments to some of the foreign ownership limits. So I think FTSE Russell will come first. It could come as early as September 26th this year, or it will be next year. And I think MSCI is still a long way away. But mood and sentiment are important. We're one notch below also from investment grade on the debt, and that's important. In our neck of the woods, you've got a lot of capital sitting in big investment funds in Australia and Singapore and Hong Kong and other places. If you get to investment grade, then you're a candidate for debt capital, which can leverage the infrastructure of the economy. And there's a lot needed to be done on energy, on transportation. So 2 things to keep an eye out. One is the bond rating, if it gets to investment grade, and then when it gets to emerging market proper for FTSE Russell. So we'll report back on that, and hopefully, in the not too distant future, those things will come to pass.
Great, thank you. Right. We should probably wrap it up there. Thank you very much, though. It's a very detailed and interesting look at Vietnam and the fund. And we shall get you back on again in a year or so and see how it's been going. We'll be back next week. I'll be talking to Ian Nance from Temple Bar. It's the best performing UK equity income fund at the moment. So we'll see what he's got to say. So have a good weekend, and I will talk to you next Friday.